Welcome to Technically Fundamental, a podcast where we bridge the gap between lines and numbers for smarter investing. I'm your host, Jakub Hajost, and today's episode will be about Meta Platforms, a company behind Facebook, Instagram, and WhatsApp. And today's episode will look slightly different than usual because I will walk you through my process of evaluating, initial evaluation of a company, using technical analysis and fundamental analysis as well. And that will be a first part of this episode. And then the second part will be a conversation with my friend Michael Lindan, in which we will dive in more detail into Facebook situation and Meta's prospects and how we think it's going to develop in the future, what Michael thinks about this company. So that will hopefully give you a more comprehensive view of the situation and how we work out our analysis of stocks and shares. So let's start with the technical analysis, the usual way. Well, obviously, should be an introduction of the company, but everybody knows what Meta is. Most of us use Facebook. They have 3 billion users now. So there's not a person in the world who doesn't know what Facebook is. You probably heard about Instagram. You've heard about WhatsApp. Maybe using it for group chat or chat with your friends. So not much of an introduction is needed here. So let's move on straight to the technical analysis. So the way we start our technical analysis is you go to trading view. Trading view, and select Meta Platforms. This will open a chart. There you go. And now, because we are long-term investors, we're looking at a 1 month chart in which every candle here is 1 month of trading since the IPO. And now we will try to ascertain something about the price movement and what's going on this chart. So the first thing you want to do right now is, we shouldn't be seeing that first. Let's look at the price at the chart alone, right? So what I start my analysis with is I'm looking for a trend line. So we need to know whether the stock is falling long term or rising long term. So we start with obviously that the trend is upward right here. So to draw a trend line, we select trend line tool here, and then we find a first low we can see on the chart. So let's make it here. And then we drag that line through a second low, and we'll see where it gets us. We are using opening prices. Right. So let's have a look a bit closer. Just move it through that opening candle line right here, and then a bit down. We should zoom in here on this and see whether it goes through actual opening price. It looks quite good here. It touches on the opening price, opening of that candle, and opening of that candle here, where it got us after so many years, almost at the right. So what we have to do as well, what we can do to improve our view of the situation is, instead of using trend line, we remove that one, we can use a channel, parallel channel, and do basically the same thing. So start with a first low, maybe with this candle, and go through the second low, see where it gets you. It gets you, well, it's all roughly, so we might as well just drag it like this and pull it up to the top and we're using closing prices here. Right now we have our channel, so we can see that the price went from the bottoms of 2013 steadily up with some corrections and then the trend accelerated and hit the roof just right here. So that gives us a channel in which the price should move right now. And then from that roof, it went back to the very bottom and then bounced back up. And so that's all we know. We're in the middle. We're exactly in the middle between the low end of the channel and high end of the channel. What do we do with it? How do we decide? How do we guess whether, or how do we try to foresee whether the price will move up or down from now? So first thing that will help us to do that are moving averages. We have to use two of them so we can see some patterns. So we're using long-term moving average for 36 periods, which is on this chart because it's a monthly chart. Each period is one candle, is 1 month. 36 periods means we've got a moving average for last 36 months. There you go. And then we use another moving average for 12 months, so for a year. So that's the moving average price for last 12 months. Boom. And what that gives us, it also illustrates where the trend is. When the trend is healthy, usually the short-term 12-month average serves as a support. So we can see right here on the chart, prices bounced up. Whenever they touch it, it's like an opportunity to buy some more, and then it goes up. Again, it touched on that line, but then bounced back up. So the correction usually leads the prices below that average, and it can even lead it below the long-term average, the 36 months average, which we noticed in 2018, and that was still an opportunity to buy. Nothing major changed on the chart. So whoever bought here was obviously, quite fortunate. But then the price bounced back up again, one more correction here, and then we're back to the price stayed above short-term moving average for considerable time, like 2 years, and then it hit that top here. Obviously, you can also see here acceleration of that trend. It goes up, and faster up. So at some point it has to hit the roof. Now, what's the difference after that? It went down so fast and so deep that short-term moving average crossed the long-term moving average, and that is called the death circle. Right, so that is called the death circle. We should have some drawing options here. Right here. This one. This is called the death circle, where the short-term moving average crosses down through the long-term moving average, and that's an indication of change of trend. Basically, we're entering a downtrend now. And this is massive. This is never happened in Facebook, on Meta chart like ever before. So this is a massive change. And so yes, so moving averages both moving averages show us where we are on the trend. So according to the books, according to the technical analysis, we are in downtrend now until that short-term moving average, which is bending upwards now, until it crosses the long-term average again, and then we're back in uptrend. But it didn't happen now. And what usually happens, like when you look at the chart before, when you're in uptrend, either the short-term moving average serves as a support, or long-term moving average serves as a support, right? But when you're in downtrend, that reverses. So short-term moving average serves as a resistance, which has been smashed right here. The price went right through that moving average. But then the long-term moving average serves as a resistance. So right now, we're at a very, very interesting point on this chart. We're right here. Right here. And this point right here is at the same time a resistance where long-term moving average is, but also the middle of the channel. So it's a strong resistance. If we smash through it, the price will probably accelerate towards the top of the channel. But if we bounce back down, that will confirm the downtrend started right here. So it's a decisive moment right now. If you buy right now and it turns out that the price bounces back down, you might want to close your position, expecting further decrease in price. If it smashes through upwards, then it's probably going to continue upward movement for quite some time. We're obviously going to see what will happen. Now, last thing we want to have a look at that will give us some more information about this chart and what might happen is, and one more note here, drawing this channel is usually better when you use a line chart, and on the line chart you can see now why it touches on this bottom here and on this bottom right here, because the line chart is drawn through closing prices, if I remember correctly. So when we switch back to the candles, it follows. And we also want to see the volume. We want to see the volume. I've hidden it, right? So, there you go. Because that's one more information telling us what's going on with the price action. And we can see right here at the end of the chart that the volume is bigger on the days when the price goes down, like massively, like this month. It went down massively on big volume, and this month it went down, finishing that downward movement on big volume, and then it bounces back up on some quite good volume right here. But then with every month and every time the price goes higher, the volume of transaction gets smaller. There's less and less people willing to trade because it's getting more and more expensive. So it's smart for those buyers, but what it tells us is that the interest in that stock is decreasing as well. So that might suggest that in this decisive moment, the stock won't go up. It might actually go down. That's only the chart. That's technical analysis, and it basically gives you a rough idea of where the stock is, how it grew over time, but it's only a chart. It doesn't tell you anything about the company, which when you buy stocks, you should know something about the company. So now for like a deeper picture or more detail, what I usually do is move on to fundamental analysis. So let's check the financials. And we will do that. That's an annual report for 2022. We've got all the numbers here. We've got our revenue. We've got our balance sheet here. We've got cash flow statement. Everything is here. So right now we're gonna move to our Excel sheet. I've done InPost here before, and we will try to get price to earnings ratio, price to book, price to sales. We will look at returns, that they show how efficient the management is in generating money. So we're gonna look at the return on equity, return on assets for Meta, and return on capital employed. And so you see how it is all calculated. Number of shares. That's all those numbers with big M are in millions. Number of shares at the end of 2022 was 2,702 million shares outstanding. And at the moment of publication of that report, the price of Facebook was $153 roughly. That was opening price of Meta shares on 1st of February 2023, after the session, after the Wall Street session, Meta published its results, and the next day the Meta shares opened quite a bit higher to $183. So market cap is obviously a number of shares multiplied by price per share. So when you multiply this, you get this number is 413 billion. That was, remember, keep in mind, this is 1st of February 2023. When we get those numbers, I will update them to more current numbers a bit later. So let's feel we for all those indicators and returns, we will need revenue, operating income, or EBIT for short, net income, equity, total assets, current liabilities, and then Excel formula will calculate the difference between total assets and current liabilities, and total assets and liabilities right here. So let's get to it. Revenue. We move on to our report, and 12 months ended December 31st, 2022. The revenue is that's the number. It's 116 billion and 609 million dollars. So let's put that number there. 116 and 609. That's our revenue. Now we need operating income, and operating income is in net income from operations, right? So that's operating income, right? Let's find it here. 28,944. 28,944. Now net income is right here. That's 23,200. 23,200. And let's find equity. Equity will be on balance sheet. And now we've got total stockholders' equity. That's this number for a year ending December 2022. Total, that's 125,713. 125,713. Total assets, and that's this number here. 185,727. 185,727. And then, as you can see, Excel formula calculated the difference between total assets and current liabilities, but it also calculated the difference between total assets and liabilities. Yes, basically it shows us total assets only because we don't have any liabilities put here. So current liabilities first, or maybe total. We'll see what we get there. Liabilities are, there you go, total current liabilities. That is 27,026. Current liabilities 27,026. And liabilities, which is total liabilities. There you go, right here. Total liabilities 60,014. 60,014. There you go. So, so now we've got all the numbers necessary. So to calculate price to earnings, we need market cap divided by net profit. So what we do is we take market cap, click, and divide it by net profit or net income. That's this number. And that's our PE ratio with the price on the opening price on the day of publication of the report. But the report was published after the session, so when people saw those numbers, and the next day the price was changed. But let's do it with the price from the 1st of February. Price to book is market cap to assets minus liabilities. So price to book, because book is assets minus liabilities. So this is like a value of the actual company when you deduct all the liabilities from your actual assets. So that will be market cap again divided by total assets minus liabilities. So by that number, and that gives us price to book of 3. Price to sales, that's market cap divided by revenue. So again, market cap divided by revenue, and that gives us price to sales ratio of 3.55. Quite good, comparable to InPost. As you can see, I've done InPost here before. Now, return on equity is net income divided by equity. Let's find equity. There you go. That's it. And that's 18.45% with return on assets. Return on assets is net income divided by the total assets. Net income divided by total assets. So return on assets is 12%. Okay, that's quite good. And return on capital employed, that's operating income, so EBIT. EBIT, boom, divided by assets minus current liabilities, so this number. And that's 18%, which is fantastic. And so now we can see all those indicators and returns. And what happened the next day? The next day, Facebook opened with new price, much higher, $183.38. That changed straight away, changed P from 17 to 21, changed price to book and price to sales. Right now, Facebook trades at about $246. Again, all those indicators went up a bit. The ones that actually include market cap, because market cap went up to this much. And now, last thing I want to say is, of course, Facebook published results for the first quarter of 2023, ending March, 31st of March. And I've done the numbers for I've done the numbers for that quarter, and this is how it looks like. Sorry. Yep. This is how it looks like. And let's just see the indicators as well. We can't divide by 0. What's going on here? Right, so let's put that in percentage. Right, some things. Yeah, I know what's happening. Right. Okay. This is just has to be moved upwards a bit. Yep, that's the one, and yeah, we've got everything. Right, so I've changed the sheet a bit, and because that column was hidden, it didn't change with it. Right, so we're back to normal. So with current price of Meta shares, what has changed during first quarter of 2023 is number of shares outstanding has changed. So that gives us a market cap of $640 billion. And revenue is, I use numbers, trailing numbers for 12 months ending on 31st of March, not March only. So revenue is a bit bigger, but EBIT is a bit smaller, and then net income went down a bit as well, and equity went down, total assets went down, current liabilities went down, and liabilities went down. So all those numbers have changed a bit. So that gives us, but what's not so nice about it is return on equity went down as well, return on assets went down, and return on capital employed went down a bit, slightly, but still those returns look a bit worse than they looked in February 2023 when Meta published results for 2022. So that gives you some indication what's going on with the company. Price to book is still a bit high, and price to sales, well, higher than it was before. PE went up as well because price went up. So you keep in mind, in February the price changed from $153 to $183, so $183. At this price, those numbers look like this. So PE went up, PB went up, PS went up as well, but returns went down. So and that's it. That's all we can gauge from numbers and charts alone. And the rest is. And the rest we're gonna touch on in part 2 of this episode when I will talk with Michael, and we'll dive deeper into Meta and what it's actually doing and what are the prospects for this company. So stay tuned and see you in part 2. Welcome to the second part of our episode on Meta platforms. I'm here with my friend Michael Lindan, and we're going to talk more in depth about Meta and their business. Welcome, Michael.
Hi, Jacob. Thank you for having me on the podcast again.
So I've done technical analysis, and I've looked in the numbers, and it looks like the first quarter of 2023 was very good for Meta. Is that right, Michael?
Yeah, I would say it is absolutely right. I mean, this company is proving themselves resilient. It's a sort of hated business that a lot of people are waiting for it to just die. But it's one of those ships that just refuses to sink. And, you know, if we look at the family daily active people, you know, that's an increase of 5% year on year, amount of users. If we look at the monthly active users, that's an increase of 5%, right? Quarter on quarter, yeah? So we're looking at the quarter ending March 31st. Facebook app daily active users, up 4%.
Oh, nice. Even
Right.
Facebook, the hated Facebook.
That's right. So the hated Facebook amount of users is actually up 4%. So, people are saying, oh, this is a dying company. Well, not according to these numbers, 5% growth in users. So the other thing is, me and you live in Europe where we're actually looking at the Facebook's report. The number of users have declined by 1%, right? But if you look more globally in places like Indonesia and Pakistan and sort of more emerging markets, the picture is quite different. So there's some tendency for geographical bias, right? And, across their family of apps, Facebook has reached the important milestone this first quarter, which is they've got over 3 billion users.
Right, so we have to think more globally. After all, it's a global company.
Absolutely. This is a large global business. So that's really something to keep in mind.
What else do they do? I know, well, everybody knows about Facebook, Instagram, and WhatsApp. But what other products do they actually have in their portfolio?
Yeah. So I think the business of Meta is often misunderstood because people just go, well, Facebook is just not popular anymore. But if you think about the actual business, the revenue and profits don't actually come from Facebook. They're not a social media company, right?
That's how I think about the company as well. Meta platforms. Oh well, social media, Instagram, filled with pictures of beautiful ladies, which is like, it was a platform for photographers in the past. Nowadays you have to compete with borderline porn, really. That's a bottom line. So you can't really. I find myself not using Instagram anymore. I find myself barely using Facebook. So there's a bias because personally, I use it less.
Well, that's right, because most people aren't familiar with the business of Facebook on Meta. They're familiar with a social media platform. Right. But actually, that's not the business. That's not the company's business, right? The company's business is basically the digital advertising, right? It's a digital advertiser, right, that has got now over 12 million of businesses which pay Meta to advertise their product. And that's to advertise their product on the platform, across the Meta platforms.
12 million businesses pay for that?
Yes.
Okay.
So 12 million paying, whether it's businesses or sole traders, but it's people doing business. Hence why they're selling something and paying Meta to advertise. Now that number was 6 million in 2018. Yeah. So actually you can see a very nice growth there from 6 million to 12 million of paid subscribers.
Right.
The ones that are actually making the money. So that's really an important number. And the other very important number is when you look at those ads, and in the first quarter, for example, here Meta, they've given us some numbers, and they're saying that ad impressions delivered across their family of apps, right, increased by 26% year over year. So what they're basically saying is paid advertisements have increased by 26% first quarter of 22 to first quarter of 2023. So they've got 26% more ads that people have paid to them for that they did in the first quarter of 2022. Now, that is impressive, right?
Yeah.
But you might say, well, okay, why is the revenues not grown at 26%? Because the average price per ad has decreased by 17% year over year. So that's, quite clever what they've done there. The amount of ads has increased by 26%, but they've decreased the pricing per ad
to lure more business.
To lure more, to achieve that growth of 26%. And as a result, their reported revenue has only increased 3%, quarter on quarter. So first quarter 22 to first quarter 2023. So increase of 3% in revenue. But on a constant currency basis, right, which excludes the currency fluctuations, the revenue has actually increased 6%. So that's the underlying story there. Yeah, the amount of paid ads have increased 26%, huge number. right? The price per ad has decreased significantly, 17%, right? So they can gain market share and gain customers that pay for these ads. And the revenue, the reported revenue as a result, increased 3%, right? Which is not a large growth, quarter on quarter. But since they've had some foreign forex headwinds, with the US dollar, in constant currency, the growth is 6%. So we come to the question of growth here. And I would venture to suggest that it's 5 to 6% because, daily active people, 5% growth, monthly active people, 5% growth, constant currency revenue, 6% growth. So here we have a company that is not just, not just refusing to die,
but still growing.
Still growing.
Right.
It's not, it's not the 30% that we witnessed over the last 10 years, but it's not going anywhere. It's still growing 5 to 6%.
How good is valued on the market right now, would you say? Like, is it undervalued? Is it still cheap for value investors, or would you consider it fair valued right now? What do you think?
Well, that's a good question. So let's have a think of this. So the current market cap is 630. So it's 640 billion. Yeah. So let's do some math. So $640 billion. Now, if we look at 2021, the more normal year for them. Well, in 2021, basically there's two businesses. They've got the digital advertising business, which is their cash producer, but they've also got the Reality Labs, which is the investments, metaverse and AI, and now that has been costing them a ton of money.
Yeah.
Right.
There's been news stories about
so there's been a lot of stories about it, and that's why you've had this, the stock got pummeled, a few months ago, because people were saying, well, this metaverse and this, the new AI initiative are just sort of not going anywhere. So, but that's a subtopic for discussion. But the question is, how much money are they really making? And in 2021, if you didn't take into account the losses in the metaverse, which by the way, it could just switch off, their main business actually made $50 billion.
In 2021, they cost about $260 to $80, $300, depends on which part of it.
So that was the big, that for me was a good demonstrator of the earning power.
Okay.
And they even say, even in the first quarter 2023 report, they say our operating margin is 40%, on the family of apps business. Right. Okay. So the revenue is what, 125 billion annually. So 40% of that is 50 billion. Now they've got no debt, right? They've got plenty of cash on the balance sheet. So 50 billion is basically pre-tax profit. And they even give you in the first quarter report that they've just released, they give you, well, our tax rate is 20%. They say, so okay, take out the 20%. So you got 40 billion, which is roughly how we think about it. So they're making 40 billion, and that's without, I'm not taking the losses that they make on metaverse into account, because those losses are deliberate. They don't have to make them, but they make them for better or for worse. So 40 billion is what they earn, and then you just divide that by 640, and you get a number of 16. Yeah, 640 divided by 40, and you get 16. And by the way, it was the 640, you've got to subtract some cash out of it as well, because they've basically got cash on the balance sheet. But, we're not even going to be doing that.
How much is it? 52 billion? Is it?
That's right. Exactly right. They've got 52 billion of current assets, which are mostly liquid cash and marketable securities, whereas the current liabilities is 25 billion.
Very well covered. Yeah.
So they're very well covered. But coming back to your questions, we calculate the real sort of PE, so to speak, or price to cash flow at about 16. And for that reason, I would venture out that it's actually lower than the S&P, an average company, the S&P. But actually, Meta Platforms is a much better company than average in the S&P, because they've got 90% gross margin, 40% operating margin, 30% return on capital employed. They've got all these profitability indicators, which are much higher than an average business. So here we have a business that is a much better than an average business, trading at a multiple lower, than an average company in the index. And then you get into the question of the future. What does the future look like to them? Bear in mind that, we've had sort of, last couple of years where, if you like, quite interesting. But when I look at it more broadly, when I look at this company more broadly over a period of 10 years, a decade, well, this company has gone from 7 billion to turnover to 116 billion turnover in 10 years. Phenomenal growth, 30% growth. Now, okay, recently it's stagnated a bit, and we're now talking 4 to 5%.
See,
But we'll see, won't we? Because those 12 million of paid advertising subscribers are not exhausted. 12 million, I would venture out to suggest, isn't particularly a huge number.
No, but but 3 billion active users, that's a massive number, and you have to think about what's the growth potential there, because there's no advertising with no active users.
True. Very good point. Yeah, it's a good point. And also,
how much revenue from advertisers they get nominally in the US and the EU, like Europe and the US, how big of a proportion of advertising income comes from there? Because of course you do that geographical bias. So they're growing in Pakistan, they're growing in Indonesia and everywhere else, but I can't imagine they make as much money over there than in the countries of West, where they probably make the massive lump of the advertising revenue. If the customer base is declining in Europe and the US, that advertising revenue will decline as well in those countries. And if it's like 90% of the revenue globally, then we might see some trouble coming yet. Unless you think 5 years from now, 4 billion users will be using Facebook.
Well, I think, the answer is no one knows 5 years from now what's going to happen. The point is, they've got their main cash machine, which is digital advertising, and they've got 12 million businesses that pay them to advertise. Now, so 12 million of paying customers. Now, the audience, as you correctly pointed out, just over 3 billion of users. And of course, in China, they can't, I don't think they're active and kind of work there. So you're right. Basically, they're kind of running out of users to advertise to. But then that's not, what I was trying to say earlier. It's the 12 million of paying subscribers. Could that grow? Because even though we've got the 3 billion users, those users don't actually pay them. The paying ones are the 12 million.
No, but the advertisers pay for active users. If you suddenly drop from 3 billion users to 1 billion, then advertisers see 66% less of the target audience. They don't pay Facebook for being Facebook. They pay Facebook for active users that actually see those ads, right?
Yeah.
But I've got another question, and it may be quite complex. Probably we won't find answer today. But the question is, I've noticed a bit of a trend internationally of weaponizing social media in a sense that one of the Montana, I think, one of the U.S. states banned TikTok for spying for Chinese government, and now you look at the Irish decision to fine Facebook. The fine is maybe meaningless compared to Facebook's cash and cash flow and revenue. But what it says between the lines is that users' data from Europe were transferred to the US, where US government can get access to it and analyze it, which means Facebook is as big data sucking government weaponized machine as TikTok for China. And that's why US is banning TikTok in some states, because they know how social media work, and they know that the government ultimately gets access to it. Why they know it? Because they do same thing with Facebook and Twitter and other social media which are American based. So, and there's a big tension between even Europe, which, Europe is allied to US, right, mostly. But they still have this tension of, hang on, these are our people. You shouldn't spy on them, and you shouldn't use them to weaponize against us, because there's some kind of intel you can gather from all this information, and we don't want your government to take that intel. And that trend of weaponizing social media can influence, I can imagine Facebook being banned in Europe. I know most people cannot imagine that, but I can. It can happen if
Absolutely, of course it can. I agree with that.
Stuff happened,
Yeah.
you know, but we obviously can't predict the future. That's entirely correct. I'm just wondering whether we might see an outflux of user base based on that, just based on idea I don't want to be spied on.
We might, you're quite right. There are risks, and this company, as it has shown, is always involved in some kind of scandal. Whether it came out Analytica in 2018,
There you go.
You know, testifying in court. But my point is, so far, it's proven resilient. Now, you made a very interesting point about TikTok being banned in Montana. Well, I would venture to suggest that if TikTok got banned entirely, then actually Meta would be the winner of that. Because that's, you know, TikTok is very much a big competitor that has been biting at Meta's market share.
Yes, when you think about it in that sense, that's, for me, it's a bit intrusive into the free market theory and the fact that we want to be investors. We want that competition to exist because maybe TikTok brings some value that Facebook is unable to bring, and that's why it's gaining market share and gaining active users in the US. And now American government trying to push away by law, not actual. There's no competition when you introduce law and ban stuff. So this is false competition. It's not actual competition. And then the same thing can happen to Alibaba then, right? When you think about it, right? Okay, it's directly competing with Amazon Cloud, with Amazon Business, and so on. So let's ban them here. Let's not allow American people to buy from AliExpress because Chinese government gonna see what they're buying. We want to be able to see what they're buying, not Chinese government.
Which is kind of what Trump wanted to do, isn't it?
Yeah. So as people who are interested, you and me, we're interested in Chinese companies. We're interested in China economy.
Big modern nation.
This kind of hostile environment and hostile actions, they're not good for business, are they?
No, they're not. And you're absolutely right. And those two big superpowers, you know, would be wise to get along.
Yeah. Okay. All right.
So yeah, it's a difficult stock to own. It's not a company without risks. So far, though, we can never know the future, but we can look at the past and we can look at the present. And when we look at the past, this company has basically successfully navigated its scandals.
Yes.
Right, including the Cambridge Analytica, has still managed to grow at 30% per annum over the last 10 years, and it's still growing at 5 to 6% per annum. Its users and its revenue has got a very, very cash-rich balance sheet. Has got a young owner entrepreneur at the helm.
Still young, yeah.
Yeah, still, he's not even 40, I don't think. And he's a market leader, certainly one of the market leaders in digital advertising, and he's basically the cheapest tech name out there, 16 times. So, and I didn't even mention the two development areas that they've got on the go, which is AI and the metaverse, right? Because, we're just taking it for granted at the moment. I think a lot of investors are taking it for granted that this AI and the metaverse are basically a useless flop.
No.
But that's not entirely clear.
No. I don't think any investor takes AI as a useless flop.
Yeah.
Metaverse, though, yes.
Yeah.
Metaverse, even I take it as a useless flop. AI, no. AI will take us further away than we are here now.
Okay.
And it's gonna be developing. So AI, Metaverse was blind alley, like a cul-de-sac for the future development of this civilization. AI probably isn't.
I'd agree with you on the AI, but on the metaverse, I think, when you look at the other companies, there's Apple, for example, has said, well, this area is very interesting to us. And even some of the cosmetics companies like Estee Lauder and L'Oreal have said that actually this is very, very interesting to us. So they're not the only ones tapping into the metaverse and trying to sort of push that space forward. So I personally don't write it off entirely, right? But I don't know whether it's going to work out or not. But what I do know is that even if it doesn't work out and is a useless flop in, metaverse, and even if AI, the AI initiatives don't work out, you've still got a digital advertising business that is as solid as ever, right? Trading on a, mid-teens multiple.
Well, as much as I like companies to try different things because you have to expand your sources of revenue, Facebook made some, or Meta made some really, well, dodgy to say the least decisions. Like they've supported NFTs, which are, if you know something about cryptocurrencies, NFTs were non-fungible tokens. So basically, in any opinion of value investor, useless crap, right?
Yeah.
But they invested heavily in that because it was popular. So they thought, well, let's do something popular. It's gonna bring stock price a bit up. Then it was metaverse, and now it's AI. This looks like those investment fads are appearing and disappearing faster and faster recently, which would indicate some kind of top of the market. You know what I mean?
Yeah.
You don't do, like, if you do your business and it just grows and it's just all good, you don't have to venture into this really weird, stupid idea.
I agree with you. They do venture into very questionable, suspect, money-losing ventures and ideas all the time. And that's just a fact. But you've got to ask the question, why? Now, I would venture to make an interesting suggestion, is that, as we know, Meta has been in a lot of scandals and it's been closely followed by governments, be that Europe, Ireland, the United States, and he's been fined over Cambridge Analytica and fined now in Ireland, etc. And I just have a sort of a soft suspicion, so to speak, that they don't want to appear too profitable and too wealthy. And so they've got to lose some money on these initiatives. Because here you have a company, right, which has got a 40% operating margin and a 90% gross margin. What do you think will happen if all of a sudden, right, they turn off all these AI initiatives, all these metaverse NFTs, all this suspect of difficult to understand money-losing ventures, and show 60, 70, 80 billion net profit.
Taxation, baby.
You're right. Do you think the governments, all over the world will not protest, especially, European Union, when they're already fining them? So I think that this whole, metaverse and, in money-losing initiatives, they have to lose some money, some way. They just can't be that profitable because people are going to get upset. They're going to get upset.
And there's always a chance some of these fads gonna hit, and then you make more money, right?
Absolutely. But even if they don't, one series, and I don't know. We're speculating. We're kind of, looking at the problem from different angles. But one theory is that they just don't want to appear super, even more super profitable than they already are, because the governments are already after them. Like that fine that you mentioned, 1.2 billion fine that they've recently had in Ireland. So that would make sense because it's taxation, it's expropriation, it's problems. So they're kind of keeping the cards close to the chest, so to speak. Now, obviously, the shareholders, would have preferred a dividend, would have preferred them to show a higher net profit, so the stock went up, etc. But I can kind of see why they're being careful. Why they've not gone all out for showing, the highest net profit they could and paying dividends, etc. Because, Europe is becoming more socialist. You said that you could see Facebook, being banned in Europe, etc. So my theory is that they're just kind of being careful with it. But at 16 times, the top and bottom of it, at 16 times multiplier, a company that is strong, solid, good balance sheet, still growing, it isn't overpriced and isn't fairly valued, in my view, comparing to similar companies. So I would say, the beauty is very much in the eyes of the beholder, but I would say there is some margin of safety even at current price.
Okay, what's the return on equity according to your calculations?
Well, if they make 40 billion net income that we've just gone through, right? And their equity is 125 billion. Yeah.
Yeah.
So you've got return of over 30%. You've got a return of
125 billion.
Yeah, that's 32, 33%. That's the return on equity. And I've taken net income over stockholders' equity, but we can do a quick return on capital calculation, which is if we take operating profit without the losses in the metaverse, if we take operating profit at 50.
EBIT, yeah?
Yeah, EBIT, exactly that. And we take the total assets, 185 here.
Well, how do you estimate actual EBIT? Because the book says it's 28 billion, right?
Yeah, well, the actual EBIT, the way I'm arrived to the EBIT is they tell you in black and white that the operating margin is 40% on the family of apps. Yeah?
Right.
So without the metaverse and AI losses and investments. So I'm just keeping those.
Which are one-time things, right?
Which they can turn on and off as they please.
Yeah. Okay. Yeah.
So if you take 40% operating margin, which is operating profit margin, out of 100, and take 125 billion annual revenue, at 40% you come to the figure of 50. Yeah, 40% of 125, which is 125 is the annual sales.
No, 125 is equity. I think revenue is 116 billion.
Oh, okay. So I'm okay. So revenue is 116. Okay, so let's adjust slightly the number.
At least at the end of 2022. That's from.
So you go to 16. Take the 40% out of that. You get 45, not 50. Okay, so you get 45. Yeah, and 40% of 116 is 45. And 45. And let's look at the balance sheet. So we're doing a return on capital calculation. So total assets 185 minus current liabilities. Right, 25. So 185 minus 25, 160. Yeah?
Mm-hmm.
And then we've got 45 over 160, which is over 25%, yeah? More than a quarter.
That's very good.
Yeah. So
return on capital.
So return on capital is over 25%, return on equity is around 30% mark.
I like very much return on capital employed because it excludes the debt from the calculation and it shows you actual money generating capability of the company.
That's right.
I like that.
That's right. Well, you're right. Return on capital is important because it shows management. Obviously, it shows efficiency. It shows management efficiency. But it shows the true profitability really because anybody can make more money by throwing more and more capital at the top of it.
Yeah, throwing money at
it. It's, debt or equity.
Yeah.
So return on capital is useful measure of profitability and it's very, very high in the case of Meta. And it's very, very high in the case of, the big six tech companies, be that Google, Amazon, that's right. Apple has got similar numbers to Meta. But, those companies are trading on twice the multiple that Meta is. They're trading on 28, 29, 30 times.
Oh yeah, Amazon's PE is very high. Yeah.
So that's so out of the big American tech companies, I would venture out to suggest that Meta is the better value.
The better value.
If you're looking for value in those names, but it's a difficult stock to own because it's always involved in some kind of scandal somewhere.
Well, but any big company sometimes is just hated. People hate Google, people hate Amazon, some people hate Twitter, people like to hate things which are successful.
Yes.
So what would you say about risk to reward ratio at this point? Would you would you venture out to calculate it on your own? Like if you were to buy stocks right now, they're trading about $248 per share.
Yeah.
How far can they go?
Nobody knows. You've got to sort of say to yourself, well, how are they going to grow at the 30% mark that they have for the last 10 years? I don't think so.
Right.
I don't see them growing at 30% over the next 10 years because, they'll just be taking over the world, won't they? But so you've got to adjust the growth, and how do you know that growth? Well, nobody knows, but let's adjust it. I would adjust it to 6%, which is what high single digits maybe, but I'm always careful and on the conservative side. So on the conservative side, I am adjusting into 6% growth.
All right.
Which they've shown in the last quarter, which is all we've got to go on. We don't know the future. Nobody knows.
Right.
So if you adjust it to 6% growth over the next 10 years, how much is this company worth? It's
Can they reach the top? The top was what, 380, 390?
Oh yeah, there's no question that they will reach. What was the highest price? 340 or something like that.
So I think 380.
Yeah,
or even
absolutely. They can easily. They can easily reach 380. They can easily reach $500-600 per share. There's no reason why they can't reach twice the. There's no reason why they can't be worth $1 trillion. Absolutely not. Which is what, 1.5? Yeah, $1 trillion. We'll take the stock to about what, 400. Yeah, $400, $410. $1 trillion market cap. So, they're 640 now.
Yeah.
So there's no reason why they can't double in size and reach 1.3 trillion. Because again, this is the company that we've just said makes 45 billion of pre-tax profit or operating profit, which is the same. They've got no debt, right? And
Yeah.
So, even if you just do a little margin expansion there and say, hey, why can't they go to 28p or 29p? That multiple adjustment from 15 to 30 gives you the doubling of the stock, right? And then if they grow at 6%, then, by the rule of 72, 7%, it'll take them 10 years to basically double their revenues. But this is a company that in the last 10 years have 10 times, or more than 10 times, 16 times their revenue. So, I'm saying, hey, can they double their revenue in 10 years? Of course they can. Do you think Facebook can double their revenue in 10 years? Most tech analysts will turn around and say, that you're very pessimistic there, aren't you, Michael? Right, of course they can double their revenue in 10 years. Well, if they double their revenue in 10 years and they have some multiple expansion, you're looking at a stock that could quadruple in 10 years, which is 15% average return per annum, going forward. And again, with a healthy balance sheet, it's a big company. It's difficult to destroy, So I think it's, if you want to be careful and conservative and invest in a big company, then I think it's a reasonable.
It's harder to find a better choice, right?
Exactly. Among the big names, if you look
the big five,
even among the big tech companies, I think it's harder to find a sort of better choice. Yeah, there's some good companies out there, Apple, for example, but you're talking at a multiple of 31. Amazon, you're talking at a multiple of, 33, 34.
Yeah, those are companies we're probably going to talk about in the future as well. But like Apple has a very, very oversaturated market at this point with iPhones. Actually, they're positively surprised with iPhone sales recently, but they're really oversaturated. Some people have 2 iPhones or 3. It's like, how many can you have? And iPads turned out to be no one using not many people use an iPad anymore. Like I remember a few years back, I've seen people with iPad all the time, and nowadays not so many. Like it turns out, big enough phone is enough. You don't need an iPad. So yeah, well that's a story for another episode. Definitely, Apple is a very, very interesting company as well, but Meta is definitely
better value. I would
better value. Yes, definitely. All right. Anything else you'd like to add to that conversation, or are we thinking about wrapping up right now?
No, I'm quite happy to wrap up. I think we've covered some good ground, Jacob. It's always a pleasure.
Right. Okay. Thank you for taking part in our episode on Meta platforms. Thank you to you, Michael, for being here with us and discussing the company. And thanks to our listeners. Remember, you're making your decisions on your own. You're grown-ups, and use your money wisely. Never treat our podcast as investment advice. If you find it difficult to invest, just maybe ask a financial advisor. But always be careful with your investment, because you can lose your money. And that's it. Yeah, see you and the next episode of Technically Fundamental, a podcast when we bridge the gap between lines and numbers for smarter investing.
Sounds sick.
Bye.
Bye.